Non-depository independent mortgage companies have regained the market share they lost during the Great Recession, and buying is a cheaper option than renting in 98 of the nation's top 100 housing markets. Ahead on Tuesday's News Wrap. Non-bank participation in the mortgage market reached its highest level in 2 decades during 2014, according to the Freddie Mac's October Insight and Outlook report released Monday. The market share of non-depository independent mortgage companies tumbled after the Great Recession with the collapse of the mortgage and secondary market, especially those companies that were focused on subprime lending. In 2014, the market share of independent mortgage companies rose to 47% for home purchase loans and 42% for refinance loans, the highest those shares have been at any point in the last 20 years. Data from the Home Mortgage Disclosure Act show that the increase in market share for non-banks has been broad-based across different loan types and demographic groups and is attributed to a number of factors. Those factors include increased capital requirements for banks, which have made the mortgage industry less profitable for banks, and increased regulation for banks, which has made those institutions more concerned about liability for noncompliance. With interest rates lower than they have been since 2012, now is likely the best time to purchase a home, according to Trulia's most recent Rent versus Buy report. The report shows that purchasing a home is 23% cheaper than renting nationwide for millennials and cheaper than renting in 98 of the nation's top 100 markets. Honolulu, Hawaii, and San Jose, California are the only metros where buying a home is more costly than renting at 5% and 2% pricier to buy, respectively. You can check out these stories on latest happenings in the industry right here on our site. Thanks for joining us. We'll see you again on Wednesday. Until then, stay with DSNews.com for all of your most relevant default servicing news.